Hello, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. Today, yes, indeed, the Bank of Japan did announce that they are raising their central interest rate by a quarter of a percentage point, so 25 basis points. However, so far, it doesn't look like markets have really taken a disliking to that. Is this potential setup right now preparation for something of a bear trap in the broader market? I'm going to point to a few things that I think indicate something like that to me, something that could be being set up here in the broader markets, and what I think that means for GameStop going forward. Certainly, it is not necessarily a continuation of not conducive, I would say, to a continuation of our recent pretty deep bearishness that we saw last week with a lot of this really heavy interventive shorting. So that's what I'm going to be thinking about today. For those of you who are new to the channel, every day prior to market open, I post analytics based on technicals and options data on GameStop. I've also started I've started to look at GameStop in some of its broader market context as well that relies on some of these same modes of analysis in order to get an idea about what that will mean, what traders are looking at, both in the immediate short and sort of medium to long term with respect to GameStop's price action. So go ahead and take a look at that if you'd like to follow along with this. This is what I break down every day here in my videos. So if you're joining us for the first time, it's linked down in the description. If you're on YouTube, if you're on Twitter, X, it is pinned up at the top of the page. So yeah, so let's get into this. Looking at, BoJ stall, right, or bear trap, right? Are we looking at, something of a bear trap developing here during the day into what was expected by many, of course, heavily to be a majorly bearish event? Of course, in recent memory, right, over the past year, the deepest, steepest correction, one of these, we had a huge spike in volatility with respect to the broader market, the S&P 500. The last time that the Bank of Japan made an announcement regarding the increase in its interest rates, this resulted in a flash crash of the Nikkei, so Japanese stock exchange, and the unwinding in large amounts of what's called the yen carry trade, where traders who are essentially borrowing free money from the Bank of Japan, then converting this into dollars and investing those dollars in US equities, suddenly had to start making interest payments on a very large amount of loaned Japanese currency that they did not have the margin to pay. And so this resulted in a very quick and rapid deleveraging of U.S. equities markets that very quickly recovered. But of course, it took many traders by surprise, took many investors by surprise, institutions who started to really prepare for this, started to get the idea that this might take place 2 to 3 weeks before the actual decision came in. We didn't see that this time, right? I mean, the Bank of Japan has been on the horizon for about as many weeks. We did have something of a correction about 2.5, 3 weeks ago, right? We went into this correction, this kind of post, sort of pre-inauguration, but kind of post New Year, something like that. Was that actually something of a deleveraging with respect to the Bank of Japan decision? Did that correction really already come? Now, we have seen some buildup. If we take a look, right, we have seen some buildup of puts gradually kind of underneath us. They've been kind of rolling up day to day. If we take a look at our big chart here, right? If we take a look back here, I think this is the Nikkei crash here. So this was the last time we had this decision. And as you can see, this took the better part of a month. I mean, this was more than a month long correction. It took to sort of 2 to 3 weeks to play out, and then another sort of week and a half to recover. we had a couple small corrections back here toward the end of last year in the fall. But really, we've been in a pretty steep, well, I wouldn't say steep, but long-lasting correction since post-election, right? So we bulled pretty hard out of the election. We had a small correction, and then we pushed to all-time highs. Then we went into about a 5-week sort of mini bear trend in here. It's the longest, I would say. Yeah, it's been even longer since that Nikkei. It's longer than that Nikkei move. Not as steep as that Nikkei move, but longer than last July, last August. Not as much as, so it's really been the longest kind of correction sequence we've had heading into this meeting. So we have actually been in that trend, but all of a sudden, basically this week, towards the end of last week, we started to make our definitive moves to kind of get out of that hole. And as we saw yesterday, right, for 2 days in a row now, the S&P has hit all-time highs. So yesterday we tapped just barely an all-time high, and then Wednesday just barely an all-time high, and then another all-time high yesterday with a definitive call wall breach of 6,100. So call wall for SPY, right? The highest concentration of overhead call gamma, right? Because traders are mostly long gamma, so dealers are mostly short gamma. So this is going to have volatility, suppression, and resistive properties overhead. Generally, when you see a call wall breach, this is based off of spot gamma statistics on the S&P. Typically, the day immediately following a call wall breach does show bearish returns. However, 5 days following a call wall breach, a major call wall breach, in about 80-something%. Well, no, excuse me, 80-something%. Following a call wall breach, when they occur, which only happens about 10 to 12% of the time on trading days, the 5-day period following that shows diminutive but still positive returns. So we now have this kind of composite net call gamma ahead of us. So if you had to pick one strike, it would be 61.45, but we have this kind of dense 3-strike accumulation here at 61.55, 61.50, and 61.45. So that's definitely our overhead on trading for today. We do have some support intraday at SPX 6100. There is still some support there. That's still overall a net positive position. So it does still look to pose a downside support there. What is interesting is immediately under that, we have 2 huge dense accumulations of put gamma. So this has been kind of walking up below us. So yesterday it was down in this area. And so what it looks like is traders have been sort of rolling their puts up on a day-to-day basis in preparation to hedge the downside of a potential unappealing reaction, let's say, to the rate change. So in terms of a bear trap, right, we could see something like if we open sort of lower, if futures kind of open us below this 6,100 level, we could and we would very quickly kind of slide down very fast, basically down to about 60.75. And we'd have a bit of a support there based on the calls that are outstanding. So we would slide down very fast. IV would spike up pretty quickly, but it would stop, right? Because we don't have this deeper put gamma below that. And even our next largest position down at 60.50, we have slight call support. But what I could see is if we slide down here, as long as traders aren't repositioning themselves to sort of open longer puts down here, we'd kind of bounce off of here and then slip back up through this position basically just as quickly, and then test call wall again at 6,100, which might carry over into next week, and then we move over into next week and maybe give the 61.50 area a test. I don't know for certain that this will happen, but based on this structure, that is a scenario I could see playing out, and that would serve to play off of these fears. A lot of these puts have been opened, to defend against how the market might react to the Bank of Japan decision. So far pre-market, it basically hasn't reacted at all. Futures are still elevated. SPY is trading down a little bit. SPY down at 609, so SPX futures still trading above that supported position at 6,100. It might not materialize. We might just go open, trade off of 6,100, and then just reverse back to the upside. So we might not get that bear trap fit there. But in terms of how traders played our expiries heading out, as we can see in our NetGex tables, out to the 7th of February, our first options expiry in February. Sentiment is bullish. It's stable. It's certainly not bearish. There's a lot of calls. Calls are definitely determining our trading structure there, unless we get something that really dislodges us. A surprise deleveraging, but this is the thing. It actually looks like this is already being priced in. So this was priced in post like sort of mid-December into December OPEX, and then it kind of continued. We played around, we stayed in this trend, but maybe we get a correction somewhere in here back down to 6,000, somewhere like maybe out toward February OPEX, but at least for now, basically out to about the middle of this OPEX window here. It's bullish, maybe not crazy bullish, maybe not up to 6,200, but kind of dance around here a little bit. That's certainly what the option structure right now is saying. Okay, what does this have to do with GameStop, Michael? Why do you keep talking about market context? Well, so as we've seen, right, especially when we move into these more bearish periods, when we see this kind of short volume teleport GameStop's price down, $7, something like, well, it wasn't selling $7 a teleportation, but in 8 trading days, we saw GameStop's underlying lose $7 to $8 of value. That's a lot, right? That's a lot to see in that short span of time. And it certainly says, oh man, if it can lose $7 to $8 of value in these 8 trading days, it could lose another $7 to $8 of value. And then I'll be really underwater. No, right? Something like that. But this only tends to occur, or these more dramatic price events, I should say, downward volatility events tend to occur, or they coincide more readily with corrections in the broader market. Not necessarily that they are causal, but it's something like it is easier for institutions to create synthetic liquidity, to short GameStop through, say, ETF borrowing or direct shorting of ETFs themselves when the market is going through a general correction. When we see the market stabilize or move into bullish conditions, it doesn't necessarily mean that GameStop itself ends up going up and having these huge bullish days or something like that. But it has lent itself at least to stable range-bound trading. So for example, in 2021, after this huge upward volatility event, we were still in this overall bull market in the S&P 500. And it wasn't until late November that we actually saw GameStop abandon its very broad range-bound structure, but this range-bound structure that was elevated way in these upper valuations above like $60, kind of oscillating between like $60 and $80 share price, or post-split adjusted. So at the very least, what that says is that continues to project, okay, we're going to have stable market conditions that therefore does lend some inclination based on also what we've seen. We'll get into this in a bit with our technicals, that we're probably looking at something a bit more range bound for GameStop. Does that mean that, okay, somebody can't come in and drop shares and just kind of have this synthetic liquidity and really coerce the price down? No, it doesn't necessarily mean that. Somebody can come in and do that. But what that says is it is a greater risk to the person to do that, unless they're really desperate, if they're rolling a swap or something, and they have to get the price down to some level, and the risk is worth it to them, then they'll still go ahead and do that. If it's do that or die, then they'll do it. But that's not necessarily low-hanging fruit. Okay, shorting GameStop, shorting 1 million shares of GameStop when it's up at these upper valuations and IV is inflated 40 to 50% above where it is now, lower risk, lower hanging fruit. Somebody who might not have to worry about rolling a swap or something like that can still do that and say, I can make a couple bucks here. Um, but when the market is good, when we're not trending down, when GameStop's already lost a lot of this value, when IV has already moved down to these lower levels, lower hanging, not lower hanging fruit, something riskier. There's less to gain by doing this. It projects in general more stability for the stock. So, okay, so why would this suggest then? Why are we seeing something like, what's going on with the price action now? Are we showing signs of recovery or moving into a range bound situation? And yes, on more local indicators, on some deeper indicators, that we are showing some support. We are showing the potential to move into something more consolidatory. We've stopped, right? The past 2 trading days have been great in terms of projecting something more range bound going forward. We've stopped logging lower lows, which is great. That's what you want to see. Yesterday, especially, this is very interesting. Some people pointed out that what causes these kind of diagonal lines. It's sort of like what we saw on Tuesday with that kind of diagonal line down very quickly, and then the sharp recovery, this kind of V-shaped recovery. So when you see something like this, right, these very sharp patterns where you see the price ride the moving averages and then just not desist from this particular angle, these are very typically volume weighted average price orders. These are average price trades that get punched in. Somebody's got to cover a position, somebody has to cover FTDs, something like that. They have to close a short position, and they want to do so in an effective way that they get the best price. They have to go out on the lit market to do it. They punch in the price. They might not have to do it, but they might choose to do it based on whether that would be advantageous to them, based on if they've secured an options position that would then benefit from them doing that. I gather that would be the case. I've never worked in one of these institutions, but if I had to do that, if I had to close out fails, I knew I had to do it by tomorrow. I'd go into the market the day before and then buy a bunch of calls. Then the next morning, punch in a volume weighted average price trade, get those fails covered, and then watch my options, pump, which would be, if you can do that, why not do that? Certainly if that's what if you're one of these people playing the game for these particular purposes, why not make that move, right? So what looked to me, right, what could this be? It may have had something to do with the overnight sort of blue ocean tech thing. What I did learn from how this works is if you have an order come in during the overnight window, if it happens before midnight, T+1 still applies. So, for example, if it comes in at 1 on a Wednesday, or it would be 1 o'clock on Thursday morning, right, 1 a.m. Eastern time, that trade could be settled on Friday, right? So you could go ahead and settle that trade on Friday. You wouldn't have to settle it on Thursday because it happened at 1 in the morning on Thursday. If, however, it happens at 11:50 p.m. on Wednesday, so the day before, then you've got to settle it that next day. So it's possible. We know that there were something like 125,000 shares published that were traded during the overnight window in reaction to whatever this reaction was to Roaring Kitty's post at 8 p.m. Eastern time, or whatever he was posting to coincide with. GameStop was the highest traded stock in the overnight market following Roaring Kitty's post. So for the whole overnight window, it was the #1 traded stock. So it may have had something to do with settlement there. It may have also had something to do with closing out fails. So 123. So yesterday's trading was T+35 from the 19th of December. And we do know that there were 333,000, the largest number of fails we've seen on GameStop, so equity fails on GameStop in quite some time, that surfaced on 12/19. So we just got that data not too long ago. Obviously, that's, T+35 is a window. It's not a delivery date. And they'll often choose to settle things the day, kind of the day before. There's also holiday extensions that play in there. But there were a large amount of fails there. And it may have been that, Roaring Kitty came in, did some stuff with the price. We just hit these, like the lowest lows we've seen in a while. And it turns out that an average price trade does come in at around, it would be lower than what the closing price, the opening and closing prices were on the 19th of December. So this average price trade, when punched in, would still result, like if somebody had to close all those fails, would still result in that short trade ending up being net profitable. Just something to pay attention to. Hard to say, okay, what exactly was this? Is it possible that this was, shorting to try to control that? We saw shares do some weird stuff, right? We saw shares available to borrow in that overnight window disappear by 1 million. So the international brokers numbers, right? We saw the available number of shares shoot down from 2.5 million down to 1.4 million or 1.5 million. So they got very low. They did, by very early this morning, they did pop back up to 2.1 million. So first to 1.7 million at 3 a.m. And then at 5:30 a.m. Eastern time, actually, no, at 5 a.m. Eastern time, they pop back up to 2.1 million. They're back down to 1.7 million, actually, at the time of writing this. Let's see, what are we now? Still at 1.7, it looks like. Right. Back up to 1.8 now, so slightly higher. So maybe this had something to do with shares that had to be used to keep the price controlled in the overnight market. I'm not exactly sure how that works. It's a pretty new thing, at least for me to be familiar with. So I'm not exactly sure how that works. But in any case, maybe it had something to do with that. But this was a VWAP trade. That's what this was. This was an average price trade. And then basically when it finished filling here around 2096, and obviously a lot of this price action is not just those shares being bought. It's also hedging responses. And so it's something like, okay, we hit a moving average, and then, day traders pick it up off a moving average. It gets too expensive. It settles back down. More shares get purchased, and then it goes up, and then it works its way back down. It moves below a moving average, and then more shares get purchased, and then it just kind of grinds. Oh, and then it stops, and then it comes back down, right? So this happens along the way quite considerably, and so it doesn't like fill them all kind of at once. It fills it based on a weighted moving average in order to fill the whole position. And then then it stopped. It filled, and then everybody went, okay, bye-bye. Exit positions, exit options, sell. Maybe some shorting got in there with it too, and we worked all the way back down to the resistance line of our range bound our range bound sort of sub channel on our 4-hour chart. So things are looking good on our deeper technicals. Yet again, we against all odds, hanging out right there. We're back trading on top of the 200 weekly moving average, and we're still, look at that, we're still there right on top of the trend line. We're still there on the RSI trend line against all odds, right? Oh my gosh, that moved to 26.33 earlier in the week. It was like, oh man, is this it? Is the bull trend done? Are we going back to $23? Like, what's going on? Nope, we're still there. Still, like, we're on it. Like, for the whole week we've been trading on the trend line. It is it's very interesting to see that. That'll be something. That'll very much be something if we just kind of range bound trade just like on the trend line into I don't know, we preserve our bull trend. But hey, as long as these deeper technicals, these two, this RSI, this weekly RSI trend line and the 200 weekly, as long as we are stubbornly trading on top of these, like literally on top of them, then technically our bull trend that has originated from back in April of last year, this 8-month bull trend, is still intact. It's still intact. And how much farther it can go? Well, eventually, I don't know, right? There's this chance for something in March, April, when say volatility should be recovering back to the upside, and the expectation of whatever's going on with GameStop's annual earnings this year, it's in place, right? It's in place. If Ryan Cohen has something special planned for March, if he's got something special planned for the 26th of March, that would be when we'd start to see some pretty big bullish divergence. We'd see this really deep year-long trend kind of reach its apex crest, something like that. So as long as we're respecting these signals, that's still on the table. That's still kind of, that's the crux. That's that, what would you call it? That's the crisis point, right? That's the point of deliberation. Ooh, do we really break out and go somewhere? The real price discovery kind of occurs as a result of that, and then we cool off for another year and a half or something. But that's it, and it's still there against all odds, kind of. So yeah, looking at our daily chart, I would say though that yeah, we have a strong case being made to move into a more range bound pattern here. We have this sub pattern that's looking range bound and looks to exit us from this bear trend. But today's going to be a key day, and then into early next week. We did use a second time. We used the 50-day moving average here as a resistance level. So that's what we came back down off of that. It does project something like, right, we have one here on the 4-hour chart too, the 200 4-hour moving average. We also used that as a resistance point the other day. It projects basically into the week, probably not going above 30, that kind of 29.50 area technically is serving as a lid, as we can see too in the options data in a second. It's also doing that. But as long as we continue to move sideways, even if we use this as a resistance and kind of trade in this 28, 27 area, as long as we don't move back down here and sort of today or in a few days kind of log a lower low at 26 or 25 or something, then I could see this does seem to suggest moving into an OPEX long kind of sideways range bound trading pattern. That does look like what, as I've been thinking about this week, this does look like something that's configured right now in the options landscape. And so if that's the case, hey, awesome, right? I mean, another set of higher lows after kind of logging in the the 2050 area, and then we had this area of consolidation around, what was this, 22, 23, and then having this kind of 25, 50, 26 area consolidating here, and then 26 reversing back to the upside here. Okay, it's not consolidation at 30 anymore, but coming down, consolidating above 26, kind of rejecting 26.30 like that, finding support there, and then kind of hanging out in the 27s as our lows, 27, 26, and then kind of moving back to the upside, ping-ponging around in this area. Market makers, dealers, obviously going to be very happy with something like that because they can really juice this multiple times for IV. They can make bank off of people saying, "Oh, are we going to break through 30 this week? Or we're going to break through 30 this week?" And then a month goes by and nothing happens. Certainly out to that seems to be what's structured out into February OPEX. Let's take a look at that now. Good stuff, yeah, for this week, right? We had a lot of in the money calls come off the board, a lot of profit taking yesterday, so that's bumping our max pain up to 28. For next week, basically the way stuff's been traded, maybe some OI has been rolled, new positions open, we're basically looking at the same thing. Big call wall at 30. Market makers are going to want to keep that out of the money. Not a ton of put gamma, not a ton of open interest in terms of puts. There are some, not really a lot. 25 is looking like 25, 24 here, right? This is kind of our floor. This is something like the lowest reasonable lower bound, something like that. Yeah. We still have some support at 28, 29 in here. Yeah. So looking like the continuation of our structure, current options and market maker hedging structure heading into next week. We also had a fair bit of our put gamma, put gamma, I keep saying gamma today. Our put OI, specifically long puts, come off the board. Trader long puts come off of the board for February. So this position, which looks to be, I mean, this was a pretty good smart play to get a good deal on puts in order to hedge potential further downside into this week. If the Bank of Japan thing was going to go bad, then this was a pretty decent trade. So you weren't going like way farther out and paying a huge time premium on these puts, but also going far enough out so you're not adversely affected by falling IV, right? So long puts are tricky because they're short the price, but long IV, which means that with GameStop, long puts are a super disadvantaged trade because GameStop's volatility goes up when the price goes up, and volatility goes down when the price goes down. So a put, for example, in SPY or SPX or something like that is not double disadvantaged like that. In SPY, when the price goes down, volatility goes up. So in SPY, you want to be like, if you're betting on a downside move, being long a put is okay because volatility does go up when the price goes down. So it's okay to be long IV but short the price when you're trading puts on SPY. GameStop, you don't have that dynamic, so long puts are tough to trade. So you want to get to a point where, especially if you're going to trade out of the money stuff, where you're not super affected by IV. And if you go far enough out, you can get a decent deal on that. But my point here is some of those traders, about over the past 2 days, the OIs decreased at 25 by about 11% out at February. So these traders are going, okay, we're out of the woods for that deeper downside. Let's get out of these, reposition this money. We don't really need that level of protection anymore at this point. So at least those traders are thinking that. Still have this as a gamma negative territory here. Honestly, pretty neutral because there are likely a lot of trader short puts mixed in here, which means dealers are actually negative gamma, which means they have to hedge more than they normally would under typical assumptions by buying shares. So it's a pretty neutral area, I would say. Below, technically our gamma flip line is going to be 27.50. Honestly, it's pretty neutral. It's not like with SPY there or SPX that I just pointed out earlier, where if we kind of move through 6,100, it's just going to vacuum us right into 60.75. Not the case here, right? It's easy to short the price down there, but you're not going to get a dealer tailwind kind of really dragging you down like you would with that huge accumulation of negative GEX over in, I should say, trader negative GEX, dealer positive GEX over in the S&P. So we have still this pretty high concentration. That's very small on your screen, isn't it? Let me see if I can make this bigger. That's what I got. Oh, here we go. This is better. So we still have this pretty big concentration here of call GEX. And these are mostly trader long calls and dealer short calls. So they're going to have that volatility suppression principle. Assuming we don't get major interventive shorting, assuming Bank of Japan doesn't go, or there isn't a secret massive bearish catalyst correction to Bank of Japan, which doesn't look like it's going to be the case, then again, probably trading in the 28 to 30 range. Where we are right now, we're right here around 28.50. We could see a little, if we open sort of down and then kind of trade, in here, we could see somebody an institution try to use this to suppress IV, exit some of their short calls that they likely entered yesterday, because we had a pretty big, pretty quick appreciation in our IV. We went from per Schwab 77 percentage points up to about 80. What was it? No, it was 75 up to 88 in a few minutes at the open. So big reversal there in IV. So a lot of knowledgeable traders sold calls into that. If a major institution did it, they'll probably want to push the price down to exit those positions. If they can, flatten things out maybe for a couple hours, and then, like, I don't know, 11:30, something like that, come in. If they short the price down to do that, then they can wait. Then they can cover all their shares at once and then send it kind of back up here. Charm will, of course, keep these out of the money. Dealers will shed some of their long share hedges. They can bump IV back up. They can force dealers to buy back a lot of these hedges, and it'll carry it up pretty quickly and pretty explosively, something like we saw happen last Friday. Might not even go, probably won't go as high as 30. I mean, people get, if there's some reason to be euphoric, then retail traders who are just dumping money on this thing, can carry it up there. We do have some gamma above us, but I think penetrating 30, very unlikely. Would really need some big kind of catalyst to do that. Not seeing that. So, a movement probably into the 2950 area, because we do have some built up gamma there before then kind of settling back and doing 2850. If we move up kind of early into the middle of this range, if we stay in the middle of the range, like if the market maker nudges us up there into that range, then we'll just kind of ping pong along here and then kind of fall off into the close above 28 for a finish close to max pain. If for some reason, we do get some huge amount of shorting here, a million of the shares that are available to borrow just get dumped, and we get pushed through here. And then there's, simultaneously a volatility. We get this bear trap scenario in SPX, we could move, but basically what it looked to me was shown by this attempt to short the stock on Tuesday was that there isn't capitulation at these levels. This is too far above maybe bullish institutional cost bases to cause a broader capitulation. And most of retail holding the stock at this point, seeing $26 or $26.50 is not bugging out, right? Anybody who entered into like the 30s or something, entered like way up here because of FOMO and sold, like they're probably out now. It doesn't look like anybody who's in here is, because we moved up through this area so quickly. Anybody who bought in here, anybody who bought is like, bought back in like the 22s or the 23s, or maybe some people acquired some shares like back at September earnings, but there wasn't a lot of time to pick up shares in this area. So there isn't, I want to get out so I don't go in the red kind of behavior. That's kind of what that shorting on Monday showed. So there isn't dealer hedging to carry us down there, and it doesn't look like there's potential fear to exploit in order to get retail or institutions or something like that to divest themselves of their shares by really pushing it down. So the only thing, barring unforeseen market collapse for some reason, that would push it down is interventive shorting. Now, as Richard Newton's been pointing out, he is theorizing that Monday, based on his model, right, his model to try and track price lows and these sort of swap roll dates, it does look like Monday, the 27th, is a day he's projecting for a swap roll. So does that mean that an institution wouldn't actually go out there and try to take 2 million shares and then dump them all on the tape today so that the swap gets rolled while the price is low? Could happen. Maybe, I don't know, maybe that's worth it depending on how low they have to get that swap. Something to keep in mind, that can always happen. I would say, though, that, as I said earlier, that's not low-hanging fruit, right? The only real reason that I can see to do that at this point is if you're in that really kind of difficult situation and you have to take that risk with that concentrated short volume. Can it happen? Sure, but there's a very limited number of players likely who are exposed in such a way that they would go to those lengths in order to achieve that result in such a short period of time. That's obviously, right, it doesn't matter what I think, but that's how I'm thinking about this as I go into my own trading and sort of looking at what we're looking at today. So yeah, that brings us to a close. That's what we're, let's see, too far zoomed in. That's what we're looking at today. That's what I'm thinking about today. We'll see how this plays out heading into today's close, this week's close. Yeah, thanks very much for the last breakdown of this week. Looking forward to seeing many of you, if not all of you. Everyone is welcome to join for this week's weekly live stream at 4 p.m. Eastern time. So at market close, after market close, will be good. We'll break down in deeper detail some of the events that occurred this week, reflect on what we are looking at, and have some time for questions, and maybe think a little bit more about some of the swap stuff that's been right now on the first place in terms of the broader GameStop community's interest in what might be coming up as well. Maybe a little bit of, we can have a little fun with some tinfoil with respect to maybe what Roaring Kitty's been talking about here with his most recent meme. So very good. Looking forward to seeing everybody tonight at 4 p.m. Eastern time. Thanks very much. We'll see you then.